All right, I think we're live. Good morning, everybody. Jamie here. I hope everybody is doing well this morning. We are currently live, hopefully, in my Financial Literacy for Women Business Owners Facebook group. If you're not a member, please come join us, jamietrull.com/group. That's where you can get there. We're almost 40,000, I think, strong in there. And I'm live on my Jamie Trull Facebook page, and also I am live on YouTube. So if you're watching me on YouTube, make sure to like and subscribe. I think I'm supposed to say that. I don't know. My son tells me that's what I'm supposed to say as a YouTuber. I'm not sure. So anyway, today we have a really special event. I'm really excited to have one of my preferred vendors. She's been here before, so you may recognize her. This is Mernie Mendoza. I adore her. She is one of our preferred vendors, and she is in the financial planning world. So, in the personal financial planning world. So a little bit differently than what I do. I'm a CPA by trade. Mernie is all about getting your personal finances in order, making sure you're investing the way that you need to invest. And today we're going to be talking about a popular discussion, which is around retirement options. So I think that this is something that no matter what age you are, you want to be thinking of, right? I mean, I think I had my first retirement plan, I don't know. I was quite young. And so I think like we should always, no matter where we are, retirement is a conversation we should be having, whether you're in your 20s, whether you're in your 60s, right? The conversation's a little different, but we need to be having that conversation. And so I think Mernie had polled the audience, right, in the group, Mernie, about, hey, what do you want to hear about? And everybody was like, retirement options. Come talk to us about retirement options. So I'm going to toss it over to Mernie to introduce herself and tell you a little bit about her before we jump into talking all about retirement.
All right. Well, thank you. And Jamie, I adore you too. So thank you for having me here. It's been a pleasure to be a part of your preferred vendors group. And it's an awesome group of ladies to associate with. So yeah, a little bit about my background. I've been in financial services 20 plus year. After 20 years, it's just 20 plus. I'm going to stop counting the years. Just like birthdays, they don't count after 21. But 20 plus years, I've been working in the space, and I've seen everything and every kind of scenario you can imagine, from individuals, families, business owners, small cases, very simple things, and also very complex cases. So it's everything and anything in between. And what I love about it is that I can sit down and help, let's say, a single mom who's just trying to put away $50 a month. And at the same time, I can sit down with a business that has, 50 to 100 employees, and we can set up retirement plans for them as well. So nothing is too simple or too complex. And I just love working with people of all different backgrounds and all walks of life. Thank you, Facebook user, whoever that is.
I know. Make sure if you're watching this in the Facebook group, feel free to press the little button. There's a link for StreamYard so that we can see your names and know who you are. But yes, lots of our group members love Mernie. Lots of people have worked with her, had consults with her. She has helped them kind of sort out their plans. So yes, so we love you. And we love what you do. Obviously, like I have, all things money, while I mainly focus on kind of the business element of money, right? And how to manage your money within your business. Obviously, really like the picture is a lot bigger than that, because it also entails, a lot of what Mernie does as well, which is why I like to bring people on here. I love this. I love all the love you're getting, Mernie, from our,
Me too. You guys are making me feel so good this morning.
I see some familiar faces. Hi, Sarah. Here's one of our other preferred vendors, April. Another preferred vendor, Gloria. We've got so many. Okay. All right. Thanks. And then Crystal's posting the link so that you can, if you're in the Facebook group and watching, we can see who you are. Okay. So I know we have some slides. Do we want to go ahead and just jump on into it, Mernie?
Yeah, I think we could do that. So actually what I decided to do when I did that poll, I had 3 different topics. And I thought, well, these are really important. So how can I kind of put it all together? So I actually put pretty much all 3 topics into one presentation. And I'm also going to be sharing a little bit about some of my personal stuff that I actually do for myself, because I think the most powerful thing is being able to show some case studies and show how this actually applies in real life. So
in the real world, right? Yes. Exactly. Not just numbers on a page, but in the real world. Okay. So I'm going to put up the slides here. I know we've got a little bit of Mernie's jumping a little bit with their internet. We couldn't figure it out. So we're like, we're just going to go with it, but it's going to be probably no more or less noticeable, because we're going to put up the screen share now. So hopefully everybody can see that. Let us know if you can see that. And then Marnie, I think you can go through the slides on your side.
Okay, perfect. Yeah, I was just saying, I think it's just the universe's way of saying that this presentation this morning is jumping.
It's
So
jumping. Yeah,
that's why we're
it's
just
hopping.
jumping in our
It's a
seats
hopping
here.
presentation.
Awesome. So, so we're going to go into, let's see here. Can you still see that okay on your screen? Did it just change?
I can see it. Yep. I see the next slide. Yep.
Okay.
Looks like we're good. Oh, now it's changing.
Oh,
That's
okay.
coming over. Yeah. There we go.
Because when I have it up, I can't see you. I can't see the screen. So,
Oh,
so
no.
let me know if you can.
That's the worst part. So we
Yeah,
can
so
see this slide right now.
Perfect. Yeah. So if you can't see me or if something's wrong with the slides, let me know because I can't see the screen when I have this up.
Yeah.
So, but anyways, just jumping right into it. Today's topic, I wanted to focus on retirement planning, but also talk about some other things that maybe people don't think about when it comes to retirement planning. And so what retirement planning is to begin with is just utilizing different financial strategies for saving and investing for the purposes of, in the beginning, accumulating towards retirement wealth. And then the second part, which again, a lot of people don't necessarily think about, but it's the decumulation of wealth. So how we're actually going to spend down that money. And so retirement planning takes both of these things into consideration. And it's also not just about, your assets and your income, but also your future expenses, some of the things that maybe we don't think about that we may have as expenses in the future. And then also quality of life and the kind of lifestyle that we want to have. And so as traditional wisdom tells us, we should have somewhere between 70 to 90% of our pre-tax of our current income. We should have that in retirement. And so we have to kind of think about if we want to maintain the same lifestyle in retirement. I know a lot of people say, oh, I'm just going to make less money in retirement, but is that really what you want? Or is that, do you want to have a smaller lifestyle in retirement, or do you want to maintain the same lifestyle? And some people actually want a greater lifestyle in retirement because they worked so hard for so many years. And when they retire, they want to be able to travel, and maybe if they have grandkids, to spoil the grandkids and do all the stuff that they weren't able to do during their working years. So it's really important to figure out, what's important to you and what is it that you're looking to accomplish, in retirement. And so I don't know if there's anything that you wanted to add.
Yeah, no, I agree with that. I'm kind of in that boat of like, one of my biggest goals is that freedom, right? Of, my biggest thing, it's even this intangible, I want to travel, but I also just don't want to worry. And I think that's where most people are, where they're in this place of like, I just don't want to have to worry about, and I think that's where it gets difficult because no one knows, none of us have a crystal ball to say how many years we're going to live, right? And
Right.
that I think is the hardest thing with retirement planning, where you're like, I don't know. Am I going to, what am I going to be around for 5 more years or for 30 more years? And there's a really big difference in there. So, yeah, I think knowing kind of what you want out of retirement is so important. And I think that I talk about this a lot, even within business planning, is that retirement, like a lot of people look for those rules of thumb, right? They want the rules of thumb, which are helpful. But you also have to know and be in touch with what you specifically want and what your goals are, what your dreams are, what you're looking towards. Because, while it's helpful to know what other people are doing, it's more important to know what you're doing. Like I very much want to retire early. So that means like I have to do things differently than somebody who wants to work until they're 65 or 70, right? So I think kind of getting in touch with that is really important.
Yeah, absolutely. And so that's where I want to kind of start, have the basis of our discussion today. Sorry, I'm having issues with my slides here. I wonder if I can just, okay. I found an easy way to do it. So another thing when it comes to how we're actually going to get to retirement is looking at taxable growth versus tax deferred. So, we could just put our money in like a general investment account and, hopefully with the way that the market's been doing, maybe not this year, but in the last couple of years, we have all this growth. But then the challenge becomes if it's taxed every year versus if we are growing it tax deferred. And so, of course, if our money is going to be taxed every year, it's like taking 3 steps forward and then taking a couple of steps back because of those taxes we have to pay every single year. And so this kind of shows you that there could be a significant difference between taxable growth and tax deferred growth. And so actually looking at the different ways that money can be taxed. So that the first one that's taxable, it's basically accounts that are taxed now. And they're taxed every single year. So things like if our savings account actually paid an interest rate, a decent interest rate, we would get taxed on that money every single year. So things like savings accounts, CDs, and then of course stock, bonds, and mutual funds. Those types of accounts, if it's not tied to any kind of retirement account, and it's just a regular brokerage account, those accounts get taxed every year. So they're still going to grow, but then they're not going to grow as much as accounts that are tax deferred. And so when should we put our money in taxable accounts? A lot of times that's around liquidity. So it's for money that we want to keep liquid that we're going to access. Sometimes it could also be for midterm goals. Like if you're planning to buy a house in 3 to 5 years, for example, it might be a good idea to have some of it grow, not maybe all of it, but a chunk of it can grow in a taxable account. Some of it you still want to keep in, let's say, a regular savings account for safety. But then anything that you want to have a little bit more growth on, you're probably going to want to put in the market because that's really the only way that your money could actually grow. But if you're looking to have it, for emergency purposes, definitely want to keep it liquid and as safe as possible. For, let's say, saving up for a major goal, for a major purchase, you may want to have it in the market. Again, keep in mind the time frame. If it's something that's really, really short term, like 6 months or a year or less, it should really just sit in your savings account. So most people get that part of it. Looking into the second one, the tax later. So this is where the majority of our conversation is going to be, is with number 2 and number 3. So our tax later accounts are things that people are either familiar with or they already have. And these are things like traditional IRAs, 401ks, 403bs, SEP or simple IRAs, 457s, depending on who they work for. And then annuities actually can fall into this category, but they're slightly different if it's a non-qualified annuity. But with the tax later or the tax deferred accounts, the premise is you put the money in now, you get a tax savings for putting that money in. That money grows tax deferred. And then on the back end, you're actually paying taxes on the principal plus any of the gains that you've had in the account. So the benefits, what are the benefits to that? Of course, if we're thinking about today, the benefit is that we get a tax benefit for putting that money in today. But what's the drawback to that is that basically we have no idea what we're going to get taxed on in the future, because hopefully that money is going to grow as much as possible. We're going to have as big of a nest egg as possible in the future. But then the challenge on the back end, and this is what I see with a lot of people that are now entering into that phase of decumulation and they're actually starting to draw from their retirement accounts, is that if 100% of their retirement money is coming from this tax deferred bucket, the biggest challenge is now they're actually sometimes ending up with less money in retirement than they thought because they didn't take taxes into consideration. So I don't know how you feel about this, Jamie, but I have a feeling that our tax brackets are probably going to go up in the probably not so distant future, but the chances of taxes are going up are greater than them going down at this point. I don't know what you think about that, but that's where my viewpoint is.
Yeah, I think that's probably true. It depends a little bit on where you land in that structure. Obviously, the more you make, I think that's more likely for tax rates to go up over time. They're fairly low right now. But I'll say it's interesting too when we talk about this, right? Because as a CPA, and this took me a minute when we first talked about this, and one of the things that I want to call out when we're looking at this, because I think of things slightly differently, but we're saying the same thing, but we say it in different ways. Because when I think of a Roth IRA, because what you're talking about here is the earnings, right? And that's really important to solidify, because if people are confused, it might be because, remember, we're talking about the earnings and the interest here. Okay, so we're not talking about the principal. That's handled separately. So, because when I think of a Roth IRA, I think of taxed now, but not later, right? Like that to me is because the principal is taxed now. We pay those taxes on the amount, but we don't pay any taxes, right? That's where the tax never comes in on the earnings. And so as a CPA, one of the questions when people are trying to figure out what to do to save money on taxes, a lot of times the impetus is to put money into these tax later things, because those things save you money on taxes now, right? You're going to pay a lower tax rate probably now. You're going to save some money now, but you're going to have to pay it into the future. That's not a bad thing, right? It's just you want to know, and that's where oftentimes we get very focused, and I see this with business owners a lot. We get very focused on the goal being reducing taxes right now, today, this year, because that's what affects our bank account. That's what affects our checkbook right now. But what we really need to think about, and why having a financial planner and a longer term mindset, because even your CPA may be more concerned about today than they are 5 years from now, than they are in the total picture when you retire, right? So that's why it's important to kind of have both sides of the coin where, okay, we want to balance, what we're doing today with what's also best for us over the long term. And that's where it's good to understand, okay, do I expect my tax rate to be higher today than it is later when I take this money out? What do I expect to happen in my life that will lead to that? And I think you're probably going to get to this, Marnie, but I'm guessing that the answer isn't, let's put everything we have into a tax never. It's probably some combination, right? Depending on your goals.
Yeah, I mean, actually, you're going to probably have money across all three because
Yeah.
you need to have money that's there for liquidity purposes and
Yep.
again for various reasons. The tax later is the only challenge. The challenge that I see with that with people that are, let's say, right now entering into retirement. Some of them still have, let's say, traditional pensions, and so traditional pensions are still taxed when they get that income in the future. And so if they have a traditional pension and then they're drawing from things like 401k, IRAs, they're basically everything, 100% of their income is subject to taxes. And I think the number one thing actually that these people tell me is that, why didn't somebody tell me about Roth IRA 10, 20 years ago? Why didn't somebody tell me that this exists? Because I would have put some money there too. So I think the way to look at it, and that's why the topic is how to determine the best plans, is to really take a look at everything. And then it's, again, not about having a single account, but having a strategy in place. And
Yeah.
so for people that maybe want to retire a little bit early, they don't want to wait until 59 and a half to be able to draw on some of those things. Well, then maybe they do need to look at some other vehicles that would actually allow them to draw funds so their qualified money could still grow, let's say to age 60, 65 or beyond, but they have other accounts that they can draw from until they get to that point. And it's almost like we want to have different buckets for retirement, some of them that we may want to draw from earlier and some of them that we may want to defer. With qualified accounts, you can defer all the way to age 72. And so that's a strategy that some people are using. They're waiting on taking those, required minimum distributions until when they absolutely have to. And so between now and then, they may be drawing from other accounts. Some people are still working, so they don't want to add on additional taxable income.
Yeah.
And so the other thing I also bring up is that you're absolutely right. Your CPA's job, your tax person's job, is typically to save you on taxes today. So you work with your CPA to save you on taxes today, but then you work with somebody like me that also looks at future, right? So my whole strategy is looking at the long term and having long-term thinking, because sometimes it's not so evident, in just the culture and just how we are in the way of life. We don't really think about long-term thinking. And so that's why I want to bring in that awareness and say, this is great, but we also want to think about, what about 20 years from now or 30 years from now? What's the best way to actually, right now we're climbing up that mountain, but what's the best way to come down that mountain? And somebody once told me this analogy of, climbing Mount Everest. Most of those deaths occur not on the way up, but on the climb down. And so this is kind of like the same way to look at retirement. It's about, climbing up that mountain, you get to the peak, and now you have to figure out what's the best way to come down from that mountain. And again, we don't know if that's going to last 5 years or 20 years or 30 years. But there's a good chance that, if you're a married couple, that at least one of you, if not both, will make it into your 90s. And so thinking about that longevity piece of it is important as well.
Yeah, I totally agree with that. I love all of that.
Yep.
And yeah, I mean, going back to the conversation of competing priorities, right? Because some people may be saying, well, wait a second, if I'm going to get one advice from my CPA, one advice from a financial planner, like, what am I supposed to do here, right? And I think that can get really confusing and difficult. I do think it is important, a CPA who can help, who does have a longer term view. At least maybe your CPA is probably not going to be looking out 30 years. Your CPA should be able to look out 5 years though. So I will say, like, that is important. And it is important for you when you have those conversations, because most CPAs are going to think that you care most about, like, now and the next 12 months from now, right? Like that's what they are going to default, because that's how most people are. That's how we tend to, and you're going to think that they're a better CPA if they save you more money now. You're not going to necessarily think that if you pay more money now, but it saves you money. So they should be thinking at least 3 to 5 years. I think a CPA, like that is in the purview of a CPA, but you need to tell them, hey, I want to think about like the medium term here of what makes the most sense. Your financial planner will be able to help you with, okay, what makes the most sense long term, right? So it can be a little bit confusing. There is, that kind of tension there, but it exists because we're trying to help you, but we're trying to help you in different ways. Right. So
Right.
that's where it's really important for you as a business owner, you as somebody working with a professional in any capacity, to be really clear about what your goals are. What do you really want? Right. And work with somebody that isn't going to give you cookie cutter advice. They're going to give you advice that really, is going to embody what you are looking for and what your goals are. And that can be tough to come by, but that's what my preferred vendors do. Like Mernie.
Yeah. And actually, I've worked with several of the other preferred vendors that are basically in that either bookkeeping or tax space. And so that's one thing also, is that having a CPA or a tax professional that's willing to collaborate with whoever
Yes.
your financial professional is.
Yes.
And I do that all the time. Actually,
Yeah.
I talk to whoever their tax person is. And so we kind of sometimes come up with the numbers together because, for example, if they're looking to contribute to a SEP IRA, it's not always a simple calculation. So I always recommend working with their CPA. And if it's one of the preferred
Yep.
vendors, I'll ask for their permission to reach out to that person and talk to them, about their particular situation. And so having that conversation, and no matter who you're working with, whatever financial professionals you're working with, your financial team should be willing and able to communicate with one another, with your permission, of course, but to be able to work together to create a plan that's going to work for you. So it's not, I'm not saying, that CPAs are, that they're not looking out for your long-term interests. I think it's when you have a professional that works together with the other part of your team, just like, any type of a team, you have multiple people because everybody has their own specialty. There's, for example, these slides are amazing. And I had my team put this together. If I was going to do these slides, it would have taken me months and they would not have looked as good. So having the right people on your team, no matter what you're trying to accomplish, is so important. So that was an indirect shout out to my creative team for putting these slides together for me. But that's why we're having a team of professionals. And again, that's why I love that vendors list, because there are people with different areas of expertise, and we collaborate with each other, and we help out some mutual clients. And it's all about putting together a strategy that's best for the client that we're working with.
Yeah. And it isn't, I think when I have talked to business owners, oftentimes they come out and they're like, okay, I need to find a person that can do my bookkeeping, that can do my taxes, that can advise me on tax planning, that can do my financial planning, help me set up retirement accounts. Those are all different people. Maybe there's a few things that overlap and might be the same person. But I think, unfortunately, like as much as we want to wear the money crown and do all the money things, those are different certifications. Those are different specialties. You do not want the same person doing all of those things. But a collaborative situation is so much more amazing because you're getting the expertise from different people, but it's not this telephone game of people pulling you in different directions. And there's a collaborative approach, which I love. And I love that you work with other preferred vendors. It's one of the things that we really hoped for when we created the preferred vendors program. And a lot of our vendors have gotten to know each other. And so that's been really, really cool to see, is just like what can happen when you kind of put heads together. So I'll let you get back to that. But I wanted to answer this question. Yes, there will be a replay. There will be a replay that will be available in the Facebook group and on my YouTube channel. So if you can't watch the whole thing, no worries at all. All right, I'll let you take it away for the next slide, Mernie.
Yeah. So just touching real quick on the tax never. So for our purposes today, we're just, we've talked a little bit about the Roth IRAs. So some of the drawbacks to the Roth IRA could be that if somebody makes too much money, they're not able to directly contribute to it. And there's also talks about, getting rid of some of these loopholes that exist as far as backdoor Roths and things like that. So the two things that basically main things that people use for tax-free income in retirement is Roth IRA. And then the second one is permanent life insurance. And so I know that's one of the topics that's usually the most misunderstood in this space. And that's actually why I wanted to spend a little bit of time today to talk about that. And so just a little disclaimer, not all permanent life insurance is whole life. I know everybody says, oh, whole life is so bad, never get whole life. And I kind of almost agree with that statement, right? Except for I don't like to say never or always. But whole life is not the vehicle that's going to get you to a retirement that you need. And the reason for that is the rates of return on whole life are typically very low and fixed and determined by the insurance company. Whole life is the most expensive type of life insurance you can purchase. And also, if you're looking to overfund it, you can overfund the whole life, but then it becomes a modified endowment contract, which means it becomes taxable. And so basically what I'm trying to say is it's not the best vehicle to use for retirement planning. And so whole life and index universal life policies are not the same. And so what I'm going to be discussing today is how an index universal life policy could potentially be useful in our retirement planning. And also, I guess I should have said this in the very beginning, but all of the stuff that we're discussing today is for education purposes. Of course, for your personal situation, you always want to look for guidance with your financial professional.
Always. And I'm going to jump in here too and talk about that because when you're talking about the Roth IRA, because that's obviously like the easiest strategy if you want this like tax never, if you want your earnings to be tax never, is to max out your Roth. Now Roth limits are very low, what, like 6,000 or something like that?
Correct.
As far as how much you can't put in very much into a Roth. And they max out at, I can't remember what, but I know a lot of people max out of Roths, mid-career at least, right? So it's a great vehicle when you're young. I mean, like as soon as my kids are earning income, because I think you do need an earned income to contribute to a Roth. My goal is like, I'm going to set them up when they've got a summer job, like that's all, maybe they'll work for me. I don't know, but we're plowing it all into a Roth IRA because that's money that will grow tax-free forever. And, they can use in retirement. And that is a great vehicle for those who are trying to save for, kids in college and things like that. But eventually, like you hopefully will be at a place where you can't contribute anymore. And that's a good thing because that means you're making enough money that you can't do anything with it. And there are some strategies like this backdooring and things like that, that some people, that you may be able to do, but this is a whole different option to that. Especially if that ends up going away and they start closing some of these loopholes. So I for one have always wondered about this whole using life insurance. Like to me, it's an insurance, right? We think about it, we're like, oh, it's insurance. So it's something that you pay and you never get back. It's just in case, right? In case something happens. But the idea of it being used as a legitimate way to actually save for retirement is, really interesting to me. So let's jump into it.
Yeah, and so just jumping back to Roth IRA real quick. So it is 6,000 if you're under 50 years old. It's 7,000 a year if you're 50 and over. And again, depending on somebody's situation, that may be a great vehicle for somebody to utilize, regardless, of age. But again, if somebody's looking to maximize, and sometimes, and I'm actually going to talk about this a few slides down. But when somebody, let's say, reaches 50 and over, and now they say, okay, I have 10 or 15 years until retirement, I need to just put as much as I can into it. Putting in that 7,000 per year is not necessarily going to get them to where they need to go. And that's where something like this can come in, and these can actually work together. So none of the strategies that I'm talking about, it's not a just this or that. It's actually a combination. Let's do as many of these things that we can that fit our situation. So some of the benefits of what an index universal life can do for you, it's actually been nicknamed the Swiss Army knife of financial strategies because you can take care of multiple things all within one program. So the main thing, number one, it is life insurance, and that's where a tax-free inheritance can come into play. So death benefits are paid out income tax-free, so beneficiaries receive that without having to pay income taxes. If you have a large estate, state taxes may be an issue, but that, we're talking, once we get into the, above 10 million, let's say. So for most people, that's not an issue. The benefits are paid out income tax free. There's a way to grow your money with zero market risk, which I will talk about as well. There's tax-free income that you can draw from it. And then there's long-term care benefits. So all of these benefits can actually be rolled into one program. So what I did, this is my actual policy. So I'm actually sharing my personal information here. I have 3 different life insurance policies. This is one of them that I ended up getting in the last couple of years. And the reason why it took me so long to get this particular one is, number one, I was going through some medical challenges and I didn't think I was going to qualify for one. And so I had a client that had some similar medical issues like me, and she ended up qualifying and she got a great rate. So I decided to try. So back in 2020, I got another policy. This is my third life insurance policy. And my main purpose for this particular policy is that it does have that permanent life insurance. So no matter when I go, it's not a matter of if, it's when, right? I just don't know when that's going to happen. It's going to get paid out. So this policy has $500,000 of life insurance benefits. And I also set it up as an increasing, which means whatever I have in my cash value, it's also added on to my death benefit. So just looking at a couple of different points in my policy, at the end of year 20, I was 38 when I purchased the policy. So 20 years later, I'll be 58 years old. I will have paid in a total of $84,000 into my policy. And if we look at the net surrender values, I would basically have $107,000 of cash value that I could walk away with at that point. Now, that may not seem like it's very exciting, and it's not very exciting. So again, for this particular policy of mine, my goal wasn't accumulation. It was more for that permanent life insurance with the long-term care. I decided to get the long-term care because by the time my mom turned 50, she had some medical conditions and she became uninsurable for long-term care. And so I wish she had this was around when she was in her 30s or 40s, because life would be a lot different now. So because of that, from my own personal experiences and seeing other people's need when it came to long-term care, that was something that was important to me. And
I'm going to echo that just because I have some experience in this as well. Get long-term care insurance, whether it's for, a retirement savings plan or not. Like, having long-term care insurance is so important. I've seen it with my own eyes, so I feel very strongly about it.
Yeah, and I think if you've seen a parent or a grandparent, I saw my mom take care of both of my grandparents for 20 plus years of my life, probably closer to 30 years of my life. And by the time she was done taking care of them, she got really sick. And it's the person that is the caregiver ends up being more sick than the person that they cared for in some instances. So I've seen that in my personal experiences. So going back to this, at the end of the 20 years, again, if something were to happen to me at that point, the death benefit is $607,000. So that $107,000 of cash value is added on to the death benefit. And if I have a need for long-term care, I have a pool of $500,000. And I'll explain a little bit about how the long-term care benefits will work. So just again, moving forward, let's say looking at it more long-term. So 40 years down the line, now, after 40 years, I have paid in a total of $168,000, and I have almost $500,000 in cash value at $493,000. And so at that point, the death benefit is almost $1 million. So if something were to happen to me, I never use the cash value, I never touched the long-term care benefits, my family, my beneficiaries would receive almost $1 million income tax-free. Now, at this point, I am now, let's say 78 years old. Let's say I start having some health challenges. I have some options. So I have that total pool of $500,000 for long-term care, but because I have almost another, let's call it $500,000 in cash value, I can actually withdraw some of that cash value for any reason. So let's say I take out $400,000 of that and I use that for whatever I want. There's still going to be that full pool of $500,000 for long-term care benefits. So let's say I pull out that $400,000, I go to Vegas, I have fun, I do whatever, I enjoy that money, and then, I get sick, and now all of a sudden I need care. That's when that long-term care benefit would kick in. And so let's see if I have this. I'm actually going to come back to this. So the long-term care part of it, how that works is that it's based off of the face amount of the policy. So in this case, a $500,000 policy, 2% of that is $10,000. So if I were to become eligible for long-term care, knock on wood, not anytime soon, but at whatever point, it would pay out 2% of that, which is $10,000. So I could potentially get $10,000 per month from my policy to take care of my long-term care needs. And so the benefit, the way that mine is set up, it's paid out through what's called the cash indemnity benefit, which means if I become eligible for this benefit, it would give me that $10,000 and I can spend that however I see fit. I don't have to show receipts of how I spent it. I don't have to, jump through hoops to get that money. Once I become eligible, and how you become eligible, it's 2 out of 6 acts of daily living. So if you can't feed yourself or dress yourself or bathe yourself, things like that, or if there's a cognitive impairment like Alzheimer's or dementia, that could potentially kick off the benefit. And so potentially you can use that $500,000 while you're living. And that's why it's called a living benefit. So life insurance isn't just for, when somebody passes away and somebody else gets the benefit of it. You can actually set it up where it benefits you in multiple ways. Again, you can use that cash value however you see fit. If you have a long-term care event, you need long-term care, that's where this could kick in. And my particular one covers informal care, which means I can take that money and pay my spouse to take care of me, or a friend, or whoever. It doesn't have to be a formal caregiving situation. I don't have to go into a home. I can be taken care of in my own home. And if I don't need that full 10,000 benefit, I can take out 5,000 and just stretch those benefits out longer. So there's a lot of flexibility built into this compared to traditional long-term care. Now, that the kicker to all of this is the added cost of having this rider on my particular policy. Keep in mind, all of these are dependent on your age, your gender, and the amount of coverage. But it costs me $220 a year to have this benefit on my policy. And the way I see it, there's nowhere I could go to purchase $500,000 worth of long-term care for only $220 a year.
Yeah.
So that is why this comes back to be a tremendous benefit. And I'm actually going to skip back a little bit here. And I actually want to compare this to saying, what if I had just bought term 2 years ago? So if I, instead of buying this policy, I purchased a 20-year term back in 2020. So 38 years old, same rate class, all that. At the end of 20 years, I would have paid in a little less than $10,000 for because it would be about $40 a month for my term. And I'm paying $350 a month for my policy right now. So at the end of 20 years, I would have paid in less than $10,000. And at that point, if I walked away, I would basically not get anything from my policy. I obviously paid in a lot less than I would have with the permanent policy. But if I don't pass away in the next 20 years and nothing happens and I just cancel, that's it. I'm out $10,000. Nobody got anything. But if I decided to keep that policy, and let's say in the next 20 years, I develop some kind of medical condition and I want to keep that policy because I want that benefit to be there for my beneficiaries. If I actually were to just keep it as what's called an annual renewable term, those rates go up pretty much exponentially after the 20th year. So if I actually kept this policy for 40 years, I would have paid in $375,000 into it. And so if you remember back on my previous one, after 40 years, I've only paid in $168,000 and I have almost $500,000 in cash value. With my term, I paid in $375,000. I have zero cash value. And, if I pass away at that point, my family gets $500,000, but that's about it. So this is, again, when somebody says only term or only this or only that, it's not one or the other. It could be both. And I do own term on my own life. Like I said, I have 3 different policies. I have one that's for accumulation. I have a term. And then I have this. So you can have different policies for different purposes. But I just wanted to bring up this point because for when somebody says only purchase term, what if at the end of that expiration, your family still needs you? Maybe you still have a mortgage. Maybe you have a kid in college. Maybe you have a special needs child that's never going to stop depending on you. Having a 20-year term is not necessarily going to help you in the long term. So again, thinking about it beyond the next 15 or 20 years, thinking about the next 40 or 50 years. So I just wanted to bring that up because I think it's a powerful comparison to look at, what the different things out there. And again, there's a place for term and there's a place for permanent, but I just want to explain why having a permanent life insurance is not necessarily more expensive, especially when you look at it in the long run. In the short term, yes, but in the long term, it actually becomes more cost effective. And I also want to touch a little bit on how the rates of returns are determined. So with an index universal life, you do your rates of return, and this is, again, directly from my policy pages. It's based on the strategy that I picked. It has the NASDAQ 100, the S&P 500, and the Dow Jones Industrial Average. And so what they do is they look at these indices and how they've performed. If the market is up, you get whatever that return is up to a certain percentage. If the market is negative, so if you see here, starting in 2000, 2001, 2002, we got 3 negative years in a row. I know it's really hard to see, but on this last column here, you see zeros, which means the policy would have received a 0% interest because the market was negative. So when the market is down, you have protection of principal. Your money does not go down. When the market goes back up, it goes up to a certain cap. And that cap rate is different for every company. Even within the same company, they have multiple strategies. So with this one, it's up to 25% when they ran this illustration. So there's a year in here where I would have gotten 21.99% return because the market performed that. So just knowing that you're going to be between 0 and whatever that cap rate is. And when you look at a 20 to 30 year average, it's typically about 8% rate of return. And again, it's not guaranteed and it depends on the strategy, but this is a strategy that can ultimately give you protection against the downside, but still give you better upside potential. And this is why a whole life could not accomplish this, because there's no way you would get an 8%, let's say, average rate of return in a whole life policy. So I know I just said a whole mouthful, and I can see the wheels turning. And I did have one other quick case study, but I wanted to see if you wanted me to expand on any of this. I saw that we had some comments come in, so hopefully,
yeah, we did. Yeah, so I'm going to take it off screen, and then we can go back to it here in a minute. But I wanted to say I love numbers, obviously. Like, so I love having actual numbers. I love that you came. You came with like the word. Whenever I have Mernie on, she's got slides. She's got all the things, which I just adore. And I love being able to see that comparison, because I think that's the thing. Like, sometimes we're like, I mean, if you sat me down and said, what do you need from life insurance? I would just be like, and I'm a numbers person. I love numbers. So that is super helpful to kind of show. And if you're working with someone to do this, if you're kind of saying to yourself, okay, this is something I need, I've been putting it off for a while, I need to make some progress on this. You want to make sure that you sit down with somebody who can interpret this stuff for you. Because I think like where you want to be able to come from is say, here are the things that I'm looking for. Here's when I want to retire. Here's what I want in retirement. Here's what here's my family situation and what I would want for them. And talking through like all of those things so that someone like Mernie can go look at like the bajillion different types of policies right out there and the specific riders to add and the things like that to make sure that it reflects what you really need, right? And what you really want. And so that's why I think it's so important. Like, this is not something you want to go out on your own and just try to buy, right, Mernie? I would imagine.
Yeah, I don't even think you can. I mean, because you have to know exactly what you want, and most people, don't.
Yeah.
They don't know what exactly they need or want, or what's even out there.
Yeah, absolutely. And so I think I want to go ahead and give your information real quick. And I do have, let me find it, a link for you to book if you want to book a call with Mernie, who can sit down and help talk about what these options are. And these are free consultations, right, Mernie?
Yes, absolutely.
No requirement to purchase anything, but Mernie can sit down and talk about your options with you. So that is something you can book. It's also, you can find, I think the same link will be on our preferred vendors list as well. But she's got a Calendly link, and you can just pick a time that works for you and sit down with Mernie. It looks like they're little 45-minute consultations, and you can make some progress towards what is going to be the best plan for you and for what you're looking for. Right, Mernie?
Yes. And actually, I want to mention for anybody that books it through, and I have a special link for the preferred, for whoever comes through Jamie and as a preferred vendor. But whoever books a consult, I'm also sending you guys this book for free. It's just
I have that somewhere around here. You sent it to me.
I know Jamie has one as well. It's just a great little book that has a lot of different financial concepts that are pretty simple, but a lot of times we forget in our day-to-day life. So whether or not we end up doing business, but just for booking that consult and talking to me, I will get a copy of that book out to you. So you guys have it.
I love that. Okay, I'm going to answer. So somebody's got this question that I wanted to put up. Since someone suggested this type of policy paid as a lump sum versus annual premiums, pros and cons of lump sum versus annual premium.
Yeah, so typically with the index universal life policies, you can't put all of the money in. You can, but because there are limitations, you don't want to what's called MEC the policy or causing it to become a modified endowment contract. And so if you put too much money in too fast, the IRS is going to say, whoa, this is no longer a life insurance policy. This is now an investment. So in order to put those breaks in, there are guidelines for how much you can contribute to a policy. There are ways if somebody, let's say, has a lump sum and they think, well, this is burning a hole in my pocket. I don't want to keep it in my bank account. I want to put it somewhere, but it's earmarked for, let's say, to put in a strategy like this. There are accounts that are set up in conjunction with this type of policy. So it's sitting on the side, earning interest. And then every year, whatever amount is allowed to be moved into the actual policy could be automatically moved into it. So yes, if somebody does have a lump sum, they are able to do that. Typically, we're not going to just do a one-time funding because, for example, if somebody wants to put $100,000 in all at once, we can do that. But typically, the face amount has to be large enough that would allow those contributions. And so, but that's not going to be a one-time thing. So typically with lump sum, people are referring to our whole life policies. And you are able to do that because whole life does not have those guardrails in place that says, we don't want this to become a modified endowment contract. And
Yeah.
so if you have a lump sum, you can. And the benefit of, let's say, doing it annually versus monthly is that the sooner you have money in there, the sooner it can start earning interest for you and having that compound effect on the earnings part of it.
Okay, I'm gonna put up Quinn's comment real quick. Yes, I agree, and I know Quinn. I know what Quinn does. So
Hi,
yes.
Quinn.
Hi. I'll put up this question from Sarah. Does it ever make sense to move money from I guess it's a SEP IRA to a Roth?
So you can contribute to both at the same time. I don't know if I would necessarily move money from a SEP into a Roth. Sometimes you are able to do, a Roth conversions, but that's typically from a traditional IRA to a Roth IRA. So as I mentioned earlier, not to get too technical, but for people that aren't able to directly contribute to a Roth IRA, sometimes what they'll do is they'll make a contribution to a traditional IRA and just not take the tax deduction. And then they're going to turn around and convert it to a Roth IRA. So it's basically an indirect way to get money into a Roth. I can't say without knowing more details, but I would say if it was generally speaking, I would probably say no. I would not go from a Roth from a SEP into a Roth IRA. However, there may be situations where that makes sense, but generally speaking, because if you do go from a SEP to a Roth, you would have to pay taxes on whatever amount is being converted. And so depending on the situation, it may or may not be a good idea to do that. So
yeah, and I've heard of this, and I have never done it, but I have heard of like the backdoor Roth IRAs, which is an option, and some financial planners can walk you through that if that's something that's of interest, where if you're over the limits, you can still kind of contribute, but it gets a little complicated tax wise, right. For sure. So there's some things to keep in mind. So yes. Okay. And Crystal's posting more ways to get in touch with you, Marnie.
Thank you, Crystal.
Yeah, I know I took up a whole bunch of time. I know you have more slides, but I also know I don't want it to get too long because then people won't watch the replay, and I want them to watch the replay. So I think for me, the next step, hopefully you kind of, are motivated, and this is the best time if you're motivated to do something, right? This is probably something that's been on your list, you've thought about or you've heard about, and you're like, okay, I'll get to that. I want you to use this as the sign to start to get to that, right? And I've already written a couple of things that this conversation made me think about that I need to get in order. So if that's how you're feeling, I want you to take the next step. I want you to book a call with Mernie, or if you already have a financial advisor that you want to work with, that's fine too. But get the ball rolling. That's the most important thing, because this is one of those things, like, we tend to put the urgent in front of the important. I talk about that all the time, right? And that happens so much with our finances. We put the urgent in front of the important, and by putting the urgent in front of the important, we're kicking the important down, just eternally forever down the road. And then we eventually wake up one day and say, man, I wish I had taken care of this, last year or 5 years ago or 10 years ago or 20 years ago, right? Just do it today. Your future self will thank you for starting to make this progress. It's not necessarily fun, although, working with somebody like Mernie, who is so education focused, I think can make this really interesting and more fun than maybe you have in your mind.
Yeah, I do. I mean, for the people that work with me, hopefully they think it's been fun. It's fun for me because I love what I do, and hopefully that passion comes through and shines through as we're talking. But I think if you're working with somebody that's really passionate about what they do, and number one, they look out for their client's best interest, you can't go wrong with something like that. And so I know it's not maybe a fun topic to talk about, but I also focus on the good things, the fun that you can have. So that cash value, that whatever savings you have, that's for you to, that's why I said, go to Vegas and have fun with it. If that's what you want to do, it's something that you can actually have use of. And it's not just, the old boring life insurance where somebody has to die for somebody to get a benefit. There's so much more to it. And that's, again, what I just want to do is bring that awareness that it's not one size fits all. There's not just the old way of thinking about things. And there are so many books out there, on the topic that, you can, if somebody wants recommendations, I'd be happy to give them some other book recommendations as well, of books that they can read on the topic, and then, get informed and then work with somebody that you like. And hopefully you can come up with a strategy that works for you.
Yeah. I love all of that. And it doesn't have to be, right? Like life insurance, it's like, okay, now we're talking about death and long-term care. Oh, like who wants to, like, I avoid that as well. I remember my dad used to joke, at one point he had life insurance policies, and I think some were rolling off, but he had told my mother that he was a little bit worried because he was worth more dead than alive at one point. And he told me that if anything were to happen to him during this specific time frame, which was right before one of his policies, I guess, rolled off, that I should make sure to investigate. So it can be fun, right? It can be funny. We can laugh. Like, it's going to happen at some point, y'all, no matter how much we avoid it, right? It's going to happen. The two things we can't avoid, what are they? Death and taxes. So,
That's right.
so maybe we can help our tax situation while also preparing for death. That sounds fun. Awesome. Mark, we love Mark. Mark is one of our best students.
Oh, hey, Mark. Yeah.
So Mark booked a consult. That's awesome. He's a great person to chat with about this stuff. So yay. Okay, well, I'm gonna let everybody go. But hopefully this was interesting for you. Hopefully you learned something, and hopefully you're motivated to take whatever that next step is for you for planning for the things we can't control, right? Because that is super duper important. Right, Mernie?
Yes, awesome. And thanks again, Jamie, for having me. I always enjoy our time together. And
I love having you. Yeah. I'm sure we'll have you back. All right, guys.
All right.
We'll
Bye,
talk
everybody.
soon. Bye.